What's good, everybody? Welcome back to the Billionaire 23 Financial Academy. We hope video 4 has found you well. In video 4 of our Forex 101 series, we introduced brokers and market orders. We outlined what brokers are, how they help give retail traders access to the Forex market. We outlined what market orders are. We also gave on-screen or live chart examples of each and how to utilize them. In this video, we will be starting a new series or a new segment titled Billionaire 23 Forex Knowledge, and there's going to be levels to it, hence you see tier 4 here. We'll be going down from tier 4, tier 3, tier 2, and ultimately tier 1. So in this video, we will focus on risk management, which is tier 4. All of the tiers are very, very important. None is above the other. So for now, let's focus on number 4, which is risk management. If you're new, you can go back to the previous videos to catch up. If you're not, let's get started. So what is risk management and what is its importance in regards to trading? What is its importance, in regards to trading? So risk management is the ability to preserve your trading capital when executing trades by making calculated decisions beforehand regarding how much you are willing to lose and how much you'd like to make. So the key here is before you enter a trade, you need to decide beforehand how much you are willing to risk and what you are going to risk. It's not that it should be a thing of you seeing a trade and then entering in that moment. It needs to be planned. It needs to be specific. That's where risk management comes in. So without a clear understanding of risk management, you will have a really hard time when it comes to live trading. Risk management will make or break you. Believe me when I say that. You have to understand that losses will always be there. And I mean always, because the Forex market is very dynamic. No one trading style or no one trading system is 100% accurate. All of them have their flaws and you will experience losses. The key is how you deal with them and how they affect your trading account on a trade-by-trade basis. It shouldn't be a thing of you losing $10 on one trade and then $100 on the next. There should be consistency in how you win and how you lose. I hope that makes sense. And then we have trading capital or your trading balance or your trading account. So one of the most important decisions to make when you're just starting out on your Forex journey is how much capital you want to trade with and where it comes from. That's very key. You do not want to use your life savings or your grandmother's life savings or any capital that is readily available to you that you need to use for specific things. It shouldn't be for groceries. It shouldn't be for petrol or gas or anything of that nature. It should be disposable income. It should be money that you know if you lose it, it won't make you go crazy. It's very key to decide how much you want to fund your account with and where it comes from. Excuse me. The reason is because if you trade with money that you desperately need, you're more likely to make trading errors because your mindset will be messed up. You'll be thinking that if I lose this, this will happen. I won't have anything to feed my kids, things of that nature. So you should be trading with capital or money that you are willing to lose or money that you know if you lose, you will get back at some point. So if you trade with money that you readily need, you're going to end up monitoring everything and end up seeing things that are not really there in the market. Excuse the typing error here. I'll correct this before I send the PDF to the Telegram group. So this is very key. Everything that I've noted down here is very key. Feel free to note it down, or you can pause the video, write down notes, take a screenshot, however best you feel you can retain the information. And then we have what we call risk per trade. So risk per trade is the amount of money you want to risk on every trade you make and should always be consistent. This is key. It should always be consistent. If you're willing to lose $5 on your first trade, then you should be willing to lose $5 on trade number 10. irregardless of the amounts of money you've made or lost. This is key because say now, okay, we'll get to that on the live chart example. I'll show you what I mean when I say if you're risking $5 on trade 1, be willing to risk $5 on trade 10. The thing with this is if you get overconfident because you've had a couple of winning trades, most often than not, you'll decide to risk more capital because we have what we call, what's this thing called? Damn, the word just slipped my mind there. But I'll probably remember it's on the live charts. You'll just be overconfident. You'll decide to risk more capital. Then you'll increase your lot size or you won't use a stop loss because you think you're God now. And then the day you do that, that's when more than likely your account will be blown because you will let go of everything that made you successful here. The consistency of thoughts, the consistency in how you approach the markets and how you apply the stop loss, all of that will be gone once you start to get overconfident. So I'll show you a live chart example of your balance or theoretical balance, how you should be risking consistently and how you could make money consistently. So for now, let's switch over to the live chart. And let's go here. All right, so this is an example. It's only for educational purposes. Say now we have a balance of $100. We decide beforehand that we're going to be using a lot size of 0.02 on every trade, irregardless of whether our account balance goes up or down. This is what we've decided on, and we're going to stick to it. And then our risk per trade is 100 pips. That's what we've decided on beforehand. And this is what we're going to use on every trade, irregardless of whether the account goes up or down. And then our take profit per trade, we've decided will be about 400 pips. That's where we will get out of the market. So let's do a live chart example, or let's backtest. Let's backtest to be more specific. We want to go to CHF JPY and we want to just do normal supports and resistance. Let me just zoom in here. So here we have an area or price level where the market has touched. This is our first price point. So then price went up, went up, went up, went up, and then dropped down. Maybe you saw that price is dropping down. It's approaching the support level. So you get ready to buy at this level. Let's just do this. Remember, we said our lot size per trade is 0.02. So that's what we're going to use. Buy 0.02 right here at this support level. Let me just change the color. And then we said our stop loss is 100 pips. So let's just check. We have 117,512. So if you deduct 100 pips from that, we have 117,412, should be somewhere there. And then this is 100 pips. The distance from here to here is 100 pips. Let's just confirm that. Yeah, it's 100 pips. That's how much we're willing to risk. Let me just do that. We bought here at this level. And then our stop loss is all the way down here. It's 100 pips as we agreed on. And then, all right, we bought here. We said our take profit per trade is 400 pips. So let's just check. We would have bought here and then price would have shot up. Where is 400 pips? 400 pips should be somewhere around here. Let's just double check. Okay, slightly below. Gonna be 9. Okay, this is our entry points. I think I should just note that down. Entry points or entry price. Here, this blue line is our entry price, which is 117.512. Then if you add 400 pips on the right, you'll get 117.912. So this is 400 pips. Just change the color. Take profit 400 pips. Take profit is 400 pips. So if we used a lot size of 0.02, multiply this by 100, it gives you sorry about that, my calculator was off. It gives you $2. So you would be risking $2 on this trade, thus risking $2 in every trade. So say now you bought here, but then price decided to go against you. You would have lost $2 on this trade, meaning you'd be losing $2 on every trade. But on this occasion, price touched support, then went up to our take profit level. So that will be 0.02 multiplied by 400, which gives us $8. So you're risking $2 on every trade to potentially make $8 on every trade. So that's how it works. On this occasion, we were successful. We're back testing. We bought at support. Price went up 400 pips. It went beyond. But our trading system or our plan is once we approach or once we've reached 400 pips, we get out of the market. So this would be trade one. Let me classify this as trade one. Trade one, we gained $8. Trade one, $8 were gained, right? Let's open a new chart. Let's see, let's make it random. All right. We're still following the same concept here. This was just example one or trade one. So let's look for another example. Let's see. All right, let's use this one. It looks interesting. Around this level. Okay, since it's resistance, we'll use that. All right, we see where price came to this level, came back down. They retested this level again and again. So we classify this as a triple top. That's what it's called. If you entered at this level, maybe you would have seen, okay, we have a first touch, price goes down, it's approaching the second time. You sell at this level since it's resistance using 0.02. Just type that in. So we sell at resistance using our lot size that does not change, 0.02. And then our take profits is 400 pips, which somewhere, let's just measure, okay, down a bit. All right, should be somewhere here. Okay, slightly down. All right. So that's our take profit level. All 400 pips again, nothing changes. We keep everything consistent. Take profit is here, 400 pips. Our risk is 100 pips. So, okay, let me move this below. So it should be 974, around this area. Around this area would be, excuse me, risk 100 pips. Pips, not pippa. Excuse that. So same concept, buy, just that in this occasion, we sell. This is our entry price right here. We're risking 100 pips, meaning we're risking $2 again. That does not change. On every trade we take, we only risk $2. And then, like we calculated before, 400 multiplied by 0.02, which is the lot size, gives us a potential profit of $8. So that means another 8. So I think I'll write this here, trade 2. Trade 2 plus 8. So far on paper, we've made $8 on trade 2 and $8 on trade 1. So our balance would now be $116 on paper. It's not this simple in real life, which is back testing. In real life, you need to apply trading psychology, which I think is tier 1. if I'm not mistaken. I'll explain everything in detail, how trading systems work, what they are, what's the concepts of a signal. Right now on risk management, I'll explain trading psychology. I forgot what tier 3 was. Oh, I'll explain what brokers don't want you to know, because brokers aren't really your friend, but we'll cross that bridge when we get there. So on these two trades, we've made $16. Yeah, $16. Using these parameters, which never change, regardless of how much money you're making or losing, they don't change. So now let's use a potential live example. This is supports. I think we can all see that. It's an area where the market has touched numerous times. So I'll just change the arrows to blue. We have touch 1, touch 2, touch 3, touch 4. Currently prices here, they might, I don't know, they might come back here. If they do, we apply the same principles. Our entry price is 1.20288. Subtract 100 from here would be, let's see if it allows. Okay, I just need to reduce this a bit more. 188, 1.2188. Yeah, this would be our stop loss. We know we're risking 100 pips. We're risking 100 pips to potentially make, okay, I think should be here 488, if I'm not mistaken. Oh no, it's 688. I think. Let me just double check. Yeah, somewhere around here is the 400 pips that we could potentially make. Remember, this is only for educational purposes. It's not a live signal. We don't do that yet. So this would be a live example. We would make $8 if price were to come from here. If price were to do something like this, price did something maybe like that for whatever reason to supports, and then we buy here. And then we buy here, take our profit there. We know by now that this is $8. We know if that were to happen, we would make $8. But if price maybe did that instead, we know we'd only be losing about $2. $2 on the exactly, I mean. So this is the opposite scenario. If that were to happen. Now, nobody knows what price will do. This was just an educational example. We also have potentially another example here. Around this area, someone might say this is resistance. You would just apply the same principles if price were to go all the way up here. So this was the video on risk management. This was tier 4. In the next video, we will cover what brokers don't want you to know. That's tier 3. It's going to be a great video. I hope you don't miss it. Please leave a like on the video, subscribe if you're new. If you found anything of value, we are happy. Feel free to tell your friends about this, anyone else you may know who's interested. It's Mr. Billionaire 23 signing out. The PDF and other additional information will be provided on the Telegram group. The Telegram link is on our YouTube channel. Feel free to check it out. And until next time, it's been Mr. Billionaire 23.